Hello, this is Brant Speshart with Steward Wealth Strategies, and I just want to say thank you for tuning in and investing a few minutes with us today as we talk about proactive tax planning. It is year end, and I know a lot of people right now are enjoying football. They're getting excited about the World Series. In fact, by the time you watch this, you may already know who won the World Series. We've got an election right around the corner, but this is also a great time in the financial planning world to talk about year end tax planning strategies. This is also the time of year where we talk a lot about generosity. We recently released that webinar, so hopefully you've had a chance to walk that as you think about your year-end giving. But today we really want to talk about proactive tax planning, not reactive, but proactive. We like to say, would you rather do proactive tax planning or reactive tax paying? Or instead of paying, reactive tax paying kind of goes hand in hand there. But a proactive approach should and generally would produce better results. So, what is the difference between planning and preparation? Tax preparation is where you look backwards at the prior year as you file your taxes, but tax planning is where we really think about the future. We look ahead. And what we have to realize is there are different tax brackets out there. You've got the lower tax brackets, and these are the marginal rates, but the 0, 10, 12%. That makes it really obvious when we're trying to make some decisions. But if you're in the 22 to 24%, we have to really, you start having to do more calculations with your tax planning. But then if you're in the really high tax brackets, the 32, 35, and 37, you're very tax sensitive, and you have to be really careful with some of the decisions that you make. But we have to think about, are we focused on today and the immediate, or are we thinking about our taxes maybe within the short run, next year, maybe the year after that, or are we focused on more of a long-term approach? I don't think any of us really want to send more money to Washington, D.C. than we need to. I appreciate the fact that I pay taxes. I appreciate a lot of the services we receive. I'm patriotic, but at the same time, don't really want to make the IRS any more part of my financial household or even my financial legacy than need be. So right now, there are 7 tax brackets. As I showed earlier, it's 10, 12, 22, 24, 32, 35, and 37. These are the current rates for single and married filing joint households. Now, right now, most Americans are claiming the standard deduction. With the Tax Cut and Jobs Act, the standard deduction was significantly increased. And right now, for married filing joint, for 2024, the standard deduction is $29,200. For single, it's $14,600. And there is some addition if you're over the age of 65 and or blind. Now, if you generally itemize, but you're claiming the standard deduction these days, just remember the old rule was trying to accelerate and claim as many deductions as you possibly could. But right now, if you're itemizing or possibly going to itemize, it's really about timing and trying to, make sure we have a plan as far as our deductions are concerned. We talk a lot about this in our generosity webinar and a lot of our generosity strategies as far as, hey, maybe you should try to do a lot of giving all at once. But even with some of the taxes out there, state and local taxes, or some other items that medical bills that may fall under the categories for being able to be itemized, you really want to be strategic with that, because with the high standard deduction that most Americans are claiming right now, if you're able to be strategic with your deductions, it could make a big difference as far as your tax liability is concerned. And ultimately, the higher your deductions, the lower your taxable income, which generally means you're paying less in taxes. Now, for 2024, capital gains, qualified long-term capital gains and qualified dividends still have very favorable rates. Again, I said long-term. Long-term is different than short-term. We're talking about investments held over a year. But if you look at this chart, instead of the normal 7 brackets that most of us are familiar with, capital qualified dividends, qualified long-term capital gains rates are anywhere from 0 to 15 to 20%. Sometimes it makes sense to sell an investment if it's down to lock in a loss. But then sometimes, depending on that one of those brackets, it may actually make sense to sell an investment and lock in a gain. Think about it. If you're in the 0% capital gain bracket this year, and that's not going to be the next case for the next few years, when you like to claim that gain in a year, if it's going to receive a 0% tax rate, that could be a very strategic move. Also, if you have an investment that you're wanting to sell and it's down, know that losses help offset gains, and taxpayers can use up to $3,000 of capital loss to offset income. Why is that significant? Well, somebody that could be in a really high income tax bracket could use a capital loss. Remember, capital gains are at a lower tax rate, but those losses could help offset up to $3,000 worth of your income. Now, it is the end of the year. Don't forget to review your retirement plan contributions before it's too late. Most retirement plan contributions through employers have a end of calendar year cutoff. And a lot of times it's through payroll. So you want to make sure that if you're trying to max out or contribute more for this particular calendar year, work with your payroll department, talk to your retirement plan provider, and just see what it takes to max out if that's your goal and what the logistics are and the timing for doing so. 2024 retirement plan contribution limits. So overall, for a defined contribution plan between employee contribution, employer match, profit sharing, there are limits. It's really high. And if you're self-employed or you own a small business, you may be able to take advantage of these contribution limits. But for most folks, when we think of retirement plan limits, we think of IRAs, Roth IRAs, traditional IRAs. There is a limit. And for 2024, it is $7,000. But if you're age 50 and older, there's a $1,000 catch up. Now, 401ks have a higher contribution amount. You're allowed to contribute up to $23,000 to a 401k. And if you're 50 or older, there is an additional catch up there of $7,500. Now, if you're self-employed or work for a really small business that has a simple or a SEP, these are different types of retirement plans with different limits as far as contributions are concerned. A simple IRA has a contribution limit of $16,000 with a catch up for those 50 and older of $3,500. And then the SEP IRA, generally we see SEPs for self-employed individuals. Sometimes there may be employees that work for a small business that has a SEP. The SEP contribution limit is based on wages, generally what's documented through W-2, and it can be anywhere from up to 25 or 20%. It depends on the corporate structure and how folks are being paid. Roth IRA conversions are still a really hot topic. We just released a Roth conversion webinar a couple of weeks ago. Please, if you're interested in Roth conversions, watch that webinar. Roths have significant benefits. One, there's no required minimum distributions on Roth IRAs if it's your own as a participant. The funds in a Roth grow and compound tax-free. Over the long term, because you're not having to take RMDs, it's tax-free growth. It does lower overall taxable income. And for beneficiaries, the Roth can be a great tool for wealth transfer because the withdrawals from Roths for beneficiaries can be tax-free as well. But when you're making the decision to do a Roth, generally there's two things we're thinking about. We're either, we're thinking about tax bracket management, but we're also sometimes trying to think about the strategic, the long-term, the legacy. So for tax bracket management, hey, are we in a lower income tax year? Do we have less work-related income this year? Is our income lower? Do we have losses or whatever it is that may offset? Does it make sense to do a Roth conversion this year because we have lower income? Are we in a favorable tax rate or tax bracket this year versus years in the future? Are we going to have a really large itemized deduction, which may help lower our taxable income? And are we in a low tax bracket right now, or a tax bracket we're used to, but we're just trying to fill up that bracket before brackets possibly change? Now, strategically, Roth conversions can make a lot of sense if you're trying to figure out who's going to pay the taxes on these funds later on down the road. Will your widow, or widow, or will your child or children be in lower tax bracket? Will other beneficiaries be in lower tax brackets, or will they be in higher tax brackets? If the heirs that are going to receive and use these funds down the road, if they're in a higher tax bracket, it might make sense you converting while you're at a low tax bracket, so that heirs in a higher tax bracket, it's tax free for them. But then, it could be vice versa as well. Again, most Americans just don't want the IRS to be any more part of their legacy than they need to be. We're not talking about tax evasion, tax avoidance. We're talking about tax reduction through planning. Now, when you think about brackets, just know there is a different set of dollar ranges for single filers and married filing jointly. And sometimes when somebody passes away, there may not be a significant shift in income. I know for some couples, you think, oh, if one of us passes away, our surviving spouse is going to be in a much lower tax bracket. That may or may not be the case. Will they have the same pension amount, similar Social Security, other income? Will they have investments, rental property that are possibly all producing similar income? And if that's the case, just know you need to keep in mind the difference between being a married filing jointly bracket and a single filer bracket. Because if you look at this chart right here, a up to almost $200,000 could be in a 22% bracket, where if it's a single filer, up to around 200,000 could be in a 32% bracket, or up to around 100 grand, almost close to 100 grand could be in a 12% versus 22. So just know, from a planning perspective, think about today, think about the near term, but also think about the long-term future and the impact there as well. Consider qualified tuition plans if you're trying to make any sort of gifts between now and the end of the year towards education. Um, you know, for my children specifically, we use a 529 college savings plan to save for education, and you're allowed to put, a certain amount in per year within the gifting range, which right now is about 18,000. The money that goes into a 529 plan grows tax deferred, and when used to pay for qualified educational expenses, it is tax free. There's some nuances and some other opportunities out there, but just kind of keep it simple, high level. But here's the thing: from an estate planning perspective, if a grandparent really wants to help super fund education because it's really near and dear to them and it matters a lot, and they're trying to figure out, hey, how can we maximize giving? Just know you can gift up to 5 years at once into a 529 plan for a beneficiary. So there are some significant tax advantages to 529s, but also from a gifting standpoint, 529s have significant advantages. The annual exclusion limit, again, is $18,000 for 2024. Now, there are some exceptions out there. If you make a gift payable directly for medical or educational to the institution, you're not subject to the $18,000 limit. But remember, the gift is per individual to an individual. So husband and wife could both gift $18,000 to one of their children, and possibly to their child's spouse as well. So if you have a heart for giving, and I love Ron Blue's saying, do your giving while you're living so you're knowing where it's going. Think about the scenario that you may be in. You may have more money than you're ever going to spend, and you just want to leave it as part of your legacy to your heirs. Well, are your heirs in a position right now where, hey, a gift right now could be a tremendous blessing? So consider some giving while you're living. So as far as wealth transfer is concerned, most Americans will not have to worry about estate tax limitations. Right now, the current estate tax exemption is 13.6 million per person. Now, once the Tax Cut and Jobs Act sunsets in 2026, right now that 13.6 million is set to sunset down to about 7 million. So a married couple with a net worth around 26 million could be subject to estate taxes today, where that will drop down about 14 million. And there are some proposals out there to lessen this even more. But this is something that we at Steward Wealth Strategies do keep up with, because it is a financial number, but it's also a political number. 25 years ago, this 7 million or 13.6 million was only 600,000. And an estate can include insurance proceeds, the family farm, home investments, real estate, other holdings. So if this number decreases significantly, a lot of Americans could be subject to an estate tax on a federal level and a state level and the state level. And I will say these numbers are based on the Fed. You should look at the specific state in which you live because a lot of states piggyback and copy the Fed, but there's some states out there that have really unique rules where even if you're not close to these numbers here, you may be subject to some sort of estate tax from a state level if you're not careful. Qualified charitable distributions are one of our favorite generosity strategies to talk to our retirees about. We talk a lot about this in the generosity webinar that we recently released, but a qualified charitable distribution, or what's commonly called a QCD, is still a great strategy to keep in mind. When required minimum distributions begin for your traditional IRA, your 401k, keep in mind that you can take IRA money as long as you're over 70 and a half. Now, you may not be subject to RMD till 73, 74, 75, but right now it starts for folks at 73. If you're subject to an RMD, you could actually gift that directly from the retirement account to a qualified charitable organization. It counts towards your RMD, and it can be a non-taxable event. Qualified charitable distributions are one of the best generosity strategies if you have retirement accounts and you're over the age of 70 and a half. Many retirement savers love using QCDs for charitable giving. If your portfolio has grown and you have a heart for generosity and you want to help out that capital campaign, or you want to help out that scholarship fund, or you want to use this to go towards your tithe at church, consider using IRA money. We can talk more about the tax implications, talk to your CPA about the tax implications, but this can be an above the line reduction, allow you to give pre-tax money to a charitable organization and still claim that really super high standard deduction that many Americans are taking advantage of. Now, we do need to keep in mind at the end of 2025, the Tax Cut and Jobs Act will sunset. Individual income tax rates will change. Estate tax exclusions will change. They will go back to pre-2018 levels. Child care tax credit will revert to $1,000. AMT will revert. The state and local tax cap will disappear, so that some folks may enjoy that, but that's mainly if you're in areas where you pay really high state income tax. But here's the thing we have to keep in mind. The 7 brackets we're looking at today, those are 7 tax bracket or tax rates we're looking at today will adjust. Right now we're at a 10, 12, 22, 24, 32, 35, 37. We will go to a 10, 15, 25, 28, 33, 35, 39.6. If the income ranges stayed the same, it would be easy to say, hey, the average American will probably pay 3% more or fall into a 3% higher bracket. But the income ranges do change as well. And somebody making close to 90 grand today could possibly go from a 12 to 25%. A 175K household income could possibly go from 22 to 28. $350,000 household income could go from 24 to 33. And keep in mind, Roth conversions add to your income. So just don't forget that. And it's not just income taxes, capital gains rates, but also for your retirees over 65, just know your income can affect your Medicare premiums as well. But look at this. Here is a chart for income tax brackets going back to 2016 all the way up to 2030. So here we are in 2024. Next year's 2025, the last year before the Tax Cut and Jobs Act sunsets, and we revert to old income tax rates in 2026. You can see right here, 10 to 10, 12 to 15, 22 to 25, possibly touching the 28, 24% bracket, 28 to 33%. So there could be a lot of folks affected by this. And this is why we talk about tax planning. A proactive approach to your tax planning instead of a reactive approach could produce better results? Would you rather do proactive tax planning or reactive tax paying? And when you think about Roth conversions, like I mentioned earlier, watch the webinar we released already. You don't have to convert a lot. You can do small micro conversions along the way if it looks like it's going to make sense for you or not. And think about what your ultimate goal is. Is your financial plan to help you, your spouse, your children, your heirs? Are you trying to make, community impact with generosity or kingdom impact? Think about the good that can come from financial planning. Taxes provide a lot of great services, but let's be tax smart with how we handle our finances. This is why we continue to provide these educational webinars and workshops. We truly believe that knowledge is power. We will keep up with changes and we will inform you. You should expect to hear from us, your financial planning team, on a regular basis. If you have questions or concerns, please reach out to your wealth manager here at Steward Wealth Strategies or reach out to our team. We've got a team here dedicated to helping you, respond to you, talk to you about your situation. For all our wealth management clients, we want a copy of your tax return every year so we can run a tax analysis. If you're not one of our wealth management clients and you're strictly investments, please talk to us about our wealth management services. Tax planning is a great way to produce alpha and help improve better results long term. We truly appreciate you. We truly appreciate all our SWS ambassadors out there that continue to connect us with their friends, families, and coworkers, or possibly a speaking engagement. If you have a small group that you're part of, or if you know of if you're hosting Financial Peace University at your church or your workplace and you'd like a financial plan professional that is aligned from a philosophical standpoint, please reach out to us. We truly appreciate you and your trust and all the connections you've helped us make over the year. As we enter this final season of 2024, I hope the end of the year brings you and your family just good tidings, peace, happiness, togetherness. Stay well, and God bless you. And it's an honor to serve you. Thank you.